Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there. Just to let me know that it is indeed working. Hope everybody's having a fantastic afternoon. Hopefully your trading's been going well. I know we had a good webinar this morning that was really awesome. Had a lot of pips made this week, especially towards the end. So I was really excited to see those profits come in at the end there this week. So a lot of really good um, a lot of good profit coming in. So that was great to see some really good trades. But I'm excited. I've worked pretty hard on putting this webinar together today, this basic training webinar. I'm going to go into a lot more detail on what liquidity is, what supply and demand is from the very beginning, like the science of it, the definition of it, all the way to the application of liquidity and supply and demand. So I'm really excited to kind of go into those details. As always, please feel free to ask questions in the chat box as we go along. It doesn't matter what question it is. It could even be off topic. That's totally fine. I'm just here to help you. This webinar in particular is designed to help the new trader kind of get their bearings straight. And so if you have a particular question, feel free to ask those questions because that's what this webinar is for. Also, for those of you watching this on YouTube or watching this in the recording, feel free to ask questions in the comment section below. I'd be more than happy to take requests from you in the comment section and or answer any questions that you may have there. So let's go ahead and jump into this, guys. As always, I need to remind you about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys. So really cool stuff. Let's talk about what is liquidity. First of all, I got this definition just right off the internet. It says liquidity in Forex is the ability of a currency pair to be bought and sold in the Forex market without majorly impacting its exchange rate. When a currency is easily bought and sold without a lot of fluctuation in its exchange rate, it is considered a liquid currency. Okay, with that said, I want to add to this definition. So when we are trading liquidity, which is also known as supply and demand, okay, these are locations where the banks are placing their orders. Okay, they are looking to buy and sell, and it's not just banks; it's also retail traders like you and me. We're going in there and buying and selling. And so, a good, healthy market is when people are actively buying and they're also actively selling. That all changes when there's a large impulse in the market. Usually, when there's a large impulse, whether that impulse is to the upside or to the downside, that impulse creates in what's called an imbalance in the market. And we're going to talk about what imbalance is. You're going to learn about imbalance mitigation, post mitigation, liquidity grabs. These are all terms we're going to talk about and make sure that you guys understand at the end of this webinar. Now, with that all said, guys, I want to make sure that I clarify you're not going to know everything about liquidity. I mean, I'm still learning about liquidity all the time, right? But I hope that today you get a better grasp on what it is, and I hope that you're able to take this home with you so that you can start understanding, oh, I see why the market moved and turned right there. I understand why the market went up to that level now, and I understand why it turned there. That should really make your wheel spin going forward. So hopefully this class just gives you a little basis to be able to identify those market turns in the future. Okay, so yeah, that's what a healthy market is. It's just basically where there's a buyers and sellers coming together. Um, it the way it's manifested on the charts is you get a consolidation. So a market that kind of moves sideways, it has an upper range, it has a lower range, and it just moves in and out of that upper and lower range. That's a market, and that's liquidity. And when the market leaves liquidity, there's now an imbalance, and we'll talk about that in just a moment. So how can liquidity help you trade? First of all, it will help you find locations where the market is about to change directions. The reason why the market changes directions at liquidity zones is because there is what is called an imbalance, right? Imbalance, imbalance, imbalance. There's an imbalance of traders because what happens is when you have a market in consolidation and the market impulses away from that old market, you have traders who are trapped. So they were all having this party, they were having a lot of fun, and all of a sudden the DJ leaves the party. And you're like, wait, what happened? Where's the DJ? Right. And as soon as the DJ comes back for a brief moment to wherever that market was before, everyone follows back to that DJ. Anyway, you're going to see examples of that in just a second. I don't know if that's the best example, but I'm hoping it kind of helps. So usually the market will change directions at liquidity zones. You'll also learn how to trade where the big boys are placing their trades. Okay. Um, You'll learn how to take profit around liquidity as well as enter your positions around liquidity zones. Okay. And then you'll also learn how to avoid being stop hunted. Maybe you've heard of this concept before where the banks will go after your stop losses. They'll try to stop you out of trades. It's really annoying. When you learn about liquidity and how liquidity works, you're less and less likely to be stop hunted, which is awesome. The last thing, and I would say the most important thing that comes out of learning how to trade liquidity is that your risk to reward ratio is going to improve in an exponential way. A lot of people who are new to trading, they don't learn this type of concept. They don't learn about supply demand concepts. They don't learn about liquidity. They just jump in and start trading, the MACD crossovers. They learn about the SMA crossover strategies. That's what new traders learn from the very, start. Okay. My job is to help you kind of avoid a lot of that junk, because that junk doesn't allow you to get a 1 to 4, a 1 to 5, a 1 to 3, 1 to 10 even. Like those are the types of trades that put you in business. They're the type of trades that will help you create a large income from this market. You'll be able to pull large money out of this market when you have 1 to 3s and higher. I don't know anybody, literally anybody, who trades manually without a robot or an EA who can take 1 to 1s or 1 to 2s and successfully trade long term that way, especially 1 to 1. There's no way you'll make money at 1 to 1. This market is too darn good. The people we're competing against are too darn good at what they do. And there's no way you're going to be profitable if you're not pulling bigger amounts of money on the trades that you win. You have to pull big profits out of the market to be successful. And from what I've discovered in my 10 years doing this is you have to learn how to trade supply and demand. That's the only way to do it. Trust me, guys, I have traded dozens and dozens and dozens of different strategies out there. And I'm telling you that once you master supply demand concepts, that's how you're going to pull big money out of this market. Okay, so here's some examples. Let's talk about bank liquidity here. So first of all, whenever you go onto a chart, I don't care what it is or what time frame it is, if you see a large impulse in the market, so an impulse is just a move that moves up to the to the upside in a big way, or a move to the downside in a big way. A large impulse is always created by the banks. Okay, you and I and all of our friends don't have enough money. If I pulled all the people I know, my friends and family, and I said, hey, everybody, at 8 a.m. this morning, we're going to drop as much money as we have on the euro to buy the euro this morning, we still wouldn't have enough money to drive the markets. So the banks are the ones who create said liquidity, right? So um, and they create these impulses. So when you go look at a chart, I hope one of the exercises you do today and maybe this weekend is go look at the big impulses in the market, find out where they came from. If you see a big move like this in the market, this big 2 green candlesticks right here, ask yourself, why did that happen? What's the base of where that happened? What's the launching pad? Well, this is the launching pad down here. Whatever orders in the market they had right here that they were creating, obviously created this impulse at some point. And the impulse is so big that it subsequently created what's called a break of structure, okay, or BOS, okay? Whenever you guys already know that the way I trade, I require and I hope everybody else adopts this because I think it's one of the best ways to trade. You have to have a break of structure in order to even consider taking a trade in the market. If you don't have a break of structure, I don't think it's worth trading, honestly, in my opinion. So I have to have it. I have to see the market break one way. Doesn't matter if it breaks up or breaks down. I need to see a break of a strong structure level. And then I'm interested because there's blood on the streets when there's a break of structure. Because here's what happens, guys. When you have a market that's down here in this area, that's consolidating, it's going up for a little bit and then it goes down for a little bit. It has the top of the range and the bottom of the range, and it goes to the top of that and back to the bottom of it. And they're having their party. The DJ's there, they're having fun. I'll buy some this way, I'll sell some this way, buy some this way, and it's easy money for everybody until the bank's impulse and party's over. DJ's gone. Okay. And this thing impulses and breaks to the upside. Now there's blood on the streets because here's what happens. The buyers who are down here, they're sitting hot. They're sitting really good and they're happy with their order. They're like, yeah, I'm okay with the party being over. I'm just getting started. This is awesome. Now, the sellers, they're in trouble because these are the people who are down here who have sells that were partying, having fun back and forth. They're now in some trouble because they're trapped. They have positions down here that are trapped. They are now in drawdown. They are losing money on this position when this breaks a structure to the upside. They are literally suffocating in their trade and they need relief. And most traders need to find places where they're willing to escape or kind of like allow that relief to take place. And so we need to identify where that relief is most likely to occur. Well, the chances is basically from what I've studied and what I do and what I teach is when this impulse is over, there's a good chance, not always, but there's a good chance that the market may return back to the same place that it left from. So if it broke structure here and if it were to ever come back to the same place where it initially started this impulse, there's a good chance you'll get a very quick rejection from that level and the market will then continue back to its upside. Okay. So in other words, this means they left liquidity behind or orders that need to be mitigated when and if the market pulls back. So the banks also had sell positions here too when they left this market, when they broke this structure. So the banks would also like to mitigate some of the positions that they left down here. So they need to come back for their money. So when they pull back, this gives them an opportunity to mitigate the imbalance of trades, the trades that are in drawdown. They like their buy positions and then they want to keep those. And when the market comes back to mitigate the sell, they will then go ahead and close out the sells at break even and then maybe even reload the buy position down here. And then it's just off to the races. Okay. So that's what mitigation is. So buy orders were left behind. So if given a chance, they will close or mitigate at the consolidation that created the break of structure. Okay, so here's another example of this, guys. So here's that break of structure. Here's the party. Here's the party over here. We have a break of structure. After the break of structure, you have trapped orders. This is also known as liquidity, also known as supply and demand. Now, this is demand down here. So you have demand and you have trapped sellers down here. And so this market does pull back into here. It literally pulls back and returns to the liquidity or the mitigation process. It's mitigating the orders that are trapped in this area. And so when the market mitigates this zone, that's when you get an even larger impulsive move to the upside. I just didn't even have enough room on my chart here it would go beyond this chart, typically, these types of moves. So that's what mitigation is it's just the market releasing pressure and relieving the suffocated sellers down here, some of which are people like you and me, and others are basically themselves. This is their own money they left down here, and they need to come and mitigate this this pressure that's down here. That's what's going on with a liquidity grab. Okay. Let's show you some examples. So I literally just used the example of the trade we took yesterday. And I'm hoping, for those in the record, I don't know when you're watching this. Maybe you're watching this 6 months from now. Maybe you're watching it a year from now, maybe a week from now. But this is literally a trade we took in our signals program using the exact same concept, just on a sell side, not a buy side. We're looking for a short position, doing the exact same thing we talked about. So this is a trade we took last night. That made a killing. It was a great way to go into the weekend. I love going into the weekend with a great trade like this. So basically what I found yesterday, as I was looking for trade setups, I found a nice structure level right through here. Okay. The market broke that structure right here and came through this area. And technically it even broke a structure right here. But we need to go back and find the mechanism that created the break of structure. This is the consolidation area. This is the general area right up in here that led to an impulse, right? This impulse right here was created by this, okay? And so since we know that there was an impulse and there's trapped liquidity up here, there's now blood on the streets. Okay. These are people who are in a buy position. The people who are in a buy position up here are in a nervous wreck, right? They're thinking, oh my gosh, this market just impulsed to the downside and subsequently broke structure to the downside. We need to figure out how we're going to get the heck out of this trade and with the least amount of loss possible, perhaps a profit. So the way a professional trader would view this is they would say, okay, great, I'm trapped in this position. Either you could just close now, or another way is the professional trader would honestly take a professional approach and wait for the market to come back to the zone that created said impulse or said breakout that subsequently broke structure. Okay. So now this market, um, 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 we're waiting for the market to come back up into this area and then come down. Now, there's a couple of ways you can do this, and I see Emil has a question on this, but that's what I wanted to talk about. Some people will take just the last candle in a major move to the upside or a major move to the downside, and they'll call that liquidity. A lot of people out there often call it a banker's candle. You can trade it that way. For me, it depends on the situation. If I'm looking for a structure point that doesn't have a consolidation zone, then I might have to go off of just a single candle. If I have a consolidation zone like I do here, I'll just encapsulate the entire consolidation zone. Okay, so I do in this example have a consolidation up here before the impulse. So I'm just including that and calling that whole thing liquidity. That's my method. I'm sure you guys on YouTube can light me up and tell me why that's wrong. Good. Show me your funded accounts, right? Because I'm funded multiple times, six figures, 200K a piece with FTMO and my Forex funds. And that's the way I've done it. And it's worked for me. So anyway, I just have to put my authority out there because that's the way I've been doing it and it's worked really, really well. But if you have a better way of doing it and you want to show me your funded accounts, then great, show me how to do it. But that's the way I've done it. So anyway, so in recap, because this is where a lot of people get confused. Let me rewind and explain this again. So if I have a consolidation and it's an obvious, this is a range of consolidation here, I will just use the whole consolidation and call it liquidity. Okay. If I don't have a consolidation, but I have a single candle that broke liquidity, let me give you an example of this even from last night. So right up here, let me go back to this. Okay, so here's this trade, right? I have consolidation right here. I'm going to use that. Okay. Right here, I don't have consolidation. I just have a single green candle. Okay. But that green candle was the last green candle before this major down move that ultimately also broke structure right here. This was a structure break because there was a support level right here, and the market broke through that structure right here. And what created it? What was this last green candle before the move down? That's also liquidity. So you could use that one. And that's an example of a single candlestick. Okay. And that is liquidity. That just single candle right there is liquidity. I really don't like to do it that way though, if I can. I mean, sometimes you have to. But if I have an obvious consolidation like I do here, that is going to be my preferred method. Okay. So let me just read your entire question. Let me know if that makes sense or not, Emil. So he says, how do you draw out the consolidation zone? Doesn't look like the typical last up candle before moving down. Yeah, so that's what we were just talking about, right? Is I prefer to use a consolidation zone as liquidity. And I'll encapsulate the bottom of the consolidation and the top of the consolidation that created the impulse, and that is liquidity. Okay, that is supply. That's trapped supply. Or I will use a single candle that created a break of structure. So you always have to kind of, if you're struggling to find liquidity on your own because you're new to trading, I totally get it. So one of the things that I would recommend is reverse engineer it. Like if you're trying to find past liquidity, here's what you got to do. Go find major structure points in the market, okay? And like draw out major support and resistance, and then find out where that support and resistance broke in the past, okay? That's easy. Anybody can do that. You just draw a line where the structure is, and then also draw an arrow to where the structure broke, and then just follow it back. Follow it back to where that came from, you know? So here's an impulse right here. It broke structure right here, and I'm just following it back to this consolidation that created the break of structure, right? I'm just following it back. Oh yeah, this is liquidity. This is the consolidation zone that ultimately created this impulse that made another low, a lower low, and a lower high, and a subsequent break of structure. So that's liquidity right there. So you want to place your order at the start of the liquidity, and you want to stop out at this end of the liquidity zone. That's basically what you're trying to do. So as you follow the example along, this is basically what happened. As you guys know, this is the trade we took last night. And again, for those of you watching this on the recording, this is literally a signal we took. You can take this trade if you'd like, or excuse me, trades like this in the future. I actually have a link in the description below that you can click on where you can join and start taking these types of trades with us. But yeah, here you go. So basically the market continued last night. It tapped right into the liquidity zone on that single candle, and then it was just off to the races at that point, right? Emil, does that make sense, by the way, what I explained on the consolidation zone? Let's see. I see that. So drawing out the zone is more of a field because depending on how it's drawn, an entry could be missed. I guess I'm asking, could you include wicks or bodies? Yeah, I guess I didn't, I guess to kind of break it down a little bit more, you can see I did not include this wick right here. I just included all the bodies of the candles inside of this zone. And to be honest, I also used, you guys saw this yesterday too. I used this order block indicator right here from Smart Money Concepts and Lux Algo. This one right here has this area as a liquidity order block. And so I used that to identify that this was indeed liquidity, right? So you can use that as well, but no, I did not count the candlestick wick. No, I didn't do that. Now, let me give you an example of a candlestick, like a single candlestick, like a banker's candle that I would use. So for example, let's say, okay, so here you go, right here. Here's an example. So you have this candle right here is the last major candle down before a move to the upside. And you can see that's the last candle that had a, it made a lower low, right? So you can use just that single candle. And I would just go from the top of that candle to the bottom of the candle. And I do use the wick in terms of the candle. Like I'll encapsulate the entire wick to the downside. So if the candle is bearish, I will use the top of the body of the candle down to the wick bottom of the candle. Now, if I have an up move, like for example, this one right here, this bullish candle, I would use the top of the body there to the top of the wick there. And that would be liquidity right there. But I wouldn't include the wick on a bullish candle on the downside. I'd use the top of the candle. I'd use the whole candlestick body plus the wick just above it. That's what I've been doing when I'm just using, that's what I've been doing when I'm just using a single candlestick alone. Again, I do not like to just trade off of a single candlestick. It's often referred to as a banker's candle. I know a lot of companies that preach just the single banker's candle. I'm not a fan of I think that's out of context of the market, to be honest, when you're just taking a single candlestick, because you could be on a 15-minute chart looking at the same setup as somebody on an hourly chart, and that candlestick looks way different when you're looking at the two time frames. That's why I feel like it's more of a zone. But I've had people tell me all the time, like, hey, you don't just use the candlestick, don't draw out a zone. And I'm like, but dude, you're gonna miss so many trades, and you're gonna take unnecessary risks if you're just going off of a candle. So I think it's more of a zone. If you have that consolidation to work with, but sometimes you don't have that. I just showed you that example on the Euro Franc over here where we did have an example of, let me go back to it. Right here, I actually had a zone to work with. Like this is an actual, this is an actual consolidation right here. I have an actual zone to work with before the impulse. Okay. Now with this one over here, I don't really have a lot of consolidation. I just have a single candle. So this is the zone right here. That's a bearish, that's liquidity right there. And again, just go back. And again, this is how you're going to find it. And I hope everybody takes this home. In order to go back and find this, you have to reverse engineer it. So basically, before you go and find liquidity, first find structure. Okay, great. I got structure here. Great. Now I got to break a structure. Great. There's the break. Now follow the market back up. Okay, here's where it broke structure. Now just follow it, follow it, follow it, follow it. Boom, there it is. There's the last major candle before a move to the downside that subsequently broke structure. That's how you can do it, just like that. And it's the same thing that I did over here. So with this trade last night, here is structure. You can see it's definitely a structure point. It was resistance right there. It was support right here. It acted as support on this wick right here. That's definitely structure. It broke structure right here. And then you just follow the market back up, follow it up, follow it up. Okay, here it is. This is liquidity, right? You just follow it back. So you just have to reverse engineer it, and that's how you can find liquidity. And boom, that's the market literally came right, tapped into it, and then it was just gone for the rest of the day. Yep, that's it right there. So, okay, I hope that makes sense. It does come with some experience, Emil. Like it does take some time to kind of figure out how you're going to draw it out. Everybody draws it out a little bit differently. I've kind of made it a little bit more simple for my clients in terms of how you can actually go and find it. Go find it by doing the 1, 2, 3 step model. 1, find structure. 2, find the break of structure. And 3, find the liquidity. If you can at least do 1 and 2, which hopefully you can, like that shouldn't be too hard to just draw a line at a structure point. Draw an arrow where it breaks. That's 2. And then 3, just follow the market back to the thing that created the liquidity, to the thing that created the breakout, right? Let's go look at some other examples. Let me see if I can. I think we looked at, was it this trade? I'm trying to remember. I'm trying to find an example. Another example for us to take a look at. Trying to find a really good one. Well, let me just show you the trade from yesterday that I took. I'll just do that. Yeah, so here's the trade I took yesterday. This is probably just a really good example to look at. So here's the USD franc. As you guys know, when I took this trade, I liked it because I had a structure point right here. You can see that was support and it was resistance right here. Okay. It broke that level right there. Okay. So at first, all you got to do is just say, okay, let's just follow this back. Okay, great. That's where it broke structure. Just follow it back, follow it back. Oh, down here. This is an example of just using a single candle. Now, I hate to use this because that's a huge candle, right? That bear candle, that is huge, right? So I'd hate to put my buy on that. What I'd rather do, and here's what I do. This might be kind of confusing. So what I do if I have to use just a single candle, what I'll do is I'll take the adjacent candle next to the bear candle and I'll use that. As long as it encapsulates the rest of the bear candle, that's how I'll use it right there. So I have the bear candle, which is huge, freaking huge candle. And then I have the bull candle right here that's adjacent to it. I'll use the bull candle as long as the bear candle encapsulates the whole candle, which it does. It engulfs that entire candle right there. And then I'll just drag it all the way down to the wick down here. And that would be my liquidity zone. So that's how I've done it if I have to go off of just the candle method. Okay. It's confusing. You can rewind it, you can come back, but that's one way to do it. Yeah, or just move to the next trade because the risk reward is iffy. Yeah, exactly, Emil. So the problem is if you were to take this trade and start your position right there, you're not going to get the reward to risk ratio you need to make this a 1-to-5 or a 1-to-3, right? You have to be able to get something better than that. So we have to tune this down and say, okay, I think I can make this work. I can stop out down here and enter right here. That would work. Now, this one, as you guys know, never triggered. This thing just went up without us, right? So there's more to the story though, right? So this is the first structure that broke. So this would be the first area where you could place a trade. And I did place a trade here. It just never triggered. Okay. So additionally, it broke more structure. So this is another structure point right here. This acted as support right over here. And then this acted as resistance right here. And then the market broke that structure again right there. It's not a huge break, but it is a break. And that does matter. Okay. So now follow the market back. That's 2 steps. What's the third step? Follow the market back. Okay. Who created this? Oh, this is what created it right here. This last bear candle before this move to the upside. That's liquidity right there. That guy right there is liquidity. Okay. And so is this down here. So let's draw out our zones. We've already got this first zone drawn out. And then the next zone is this guy right here. Okay. That is the zone. Okay, now the market, if the market were to tap into either one of these, you're looking for buys. And sure enough, that happened. It literally tapped right into it a couple of times even, and then it was just off to the races, right? Off to the races. Okay, so that's the concept right there. So liquidity can either be a zone or it can be a single candle. I don't prefer the candle method, but it you can, and it does take some experience doing this over and over and over again to kind of figure out how to draw it out the way you want to draw it out. Like I've done it a lot of different ways where you only use the candle. Like I've done it like this, where you just use the candle alone. Let's see, would you have been okay? Yeah, you would have been fine on that one. But I've seen plenty of these where, like, if you don't encapsulate this entire zone that basically created, if you don't encapsulate that, like even these wicks down here, if you don't take those, I've seen a lot of trades where the market will come just right through that and then go in your favor. It's the worst feeling ever because you work so hard to find this trade and you set it all up perfectly, except the market whips you out by just a couple of pips, right? It's a terrible feeling. You guys have probably all felt it before. So that's why I feel like, again, there's a lot of people out there who will teach you how to trade liquidity, and a lot of them will teach you just to do a single candlestick because it's so simple. It's just easy to say, I'll just use a candle, right? Yeah, you can do it that way, but I think there's a little more to it. That's why I try to find the zone that created the break of structure, what that this whole thing basically created this impulse. And this area right here, this whole area created this impulse. So that's also liquidity, right? I'm actually curious, did that one ever get tapped? I never used it again, but did it ever get tapped into later? No, it hasn't gone that far yet. But this is interesting. This actually tapped into this liquidity again this morning. It tapped into that liquidity again and took off. Now, you guys know the drill, and if not, I'm teaching you it right now. My personal rule on liquidity is if it's been tapped into once, you can't use it again. Okay, I'm sorry, but it's just a personal rule I have, because here's what happens. If liquidity gets tapped into and mitigated once, the chances of it being useful a second time goes down drastically. Okay, so this was liquidity right here. It got tapped into and it worked. Now I don't touch it again. I will wait for a new zone. I will wait for a new setup. Okay. Technically, it came right back into liquidity this morning and worked out just perfectly. And for the people that took this trade, great. And for the people that are willing to use liquidity on the second or third try, good for you. I'm telling you though, that in my experience, if you're going to use liquidity on at least, like, especially on the third or fourth time, there's no telling what it's going to do. So that's why I'm saying, because here's the science again behind it. If you're just going to use liquidity a second or third time, it's already been mitigated, right? Like whatever orders were trapped in this area, whatever orders were trapped here, they've been mitigated right here, right? And especially now, like they've been, look how deep that one came in. It came right into liquidity, pretty deep even, and then took off. Like that one is not worth using again. Definitely, I would never use that one again. Um, I would not touch that one ever because it's definitely been used up. This one, on the other hand, you might want to consider using this one in the future, right? Because it hasn't been touched yet, right? This one could be useful. And the market's never been back down to mitigate it. So there's a chance that this one might work out. Okay. I hope that makes sense. So yeah, you have to anticipate this stuff before it even happens. And how do you anticipate? You have to find a break of structure, like a pretty recent break of structure. I always go in during the Asian session and try to find a break of structure. Um, as you guys know, that's kind of my style. I go in during the Asian Tokyo Sydney session and I look for a break of structure, um, look for higher highs, higher lows, and then I look for the market to return back to the liquidity that created that break of structure. And that's where my trade is going every time, right? And I'm going to slap a 1 to 3, 1 to 4, maybe a 1 to 5 or better on that trade. Okay. Let's see. Emil says, or just move the trade because, oh yeah, we talked about that. So zones should include swing highs and lows. It looks like, yes. Yeah. So for example, with this one that I showed you guys, I just included this whole candle plus the adjacent candles next to it because I just considered it to be a zone. It again, for those watching this who are just pro candlestick, single candlestick only liquidity guys, Obviously, that would have worked right there. Let's see, did it work on the second time? Look at that. It didn't work on the second time. This is literally why I do a zone and not a candlestick. So for all of you watching, not you guys, not my clients, but for all of you watching the recording on this on YouTube, I'm telling you, this is why I literally just showed you proof why I do a zone, not the candle. So like if you just take that single candle, that bear candle, and then you go forward, obviously it worked out right here. You would have gotten wicked out right there. See that? That's why I don't do a single candle. Okay, I do a zone. It's the zone, it's the zone, it's the zone, right? So you saw me, I was including this area, I was including this and this, those two wicks to the downside. That's liquidity. Okay, and it worked right here. And you would have been fine. You would have been able to weather this just fine too if you had included the zone, not just the single candle. So anyway, I rest my case. I rest my case, right? All right, guys, what other questions do you have about liquidity? I hope this makes sense. I am going to post this on my calendar, which by the way, it looks like I found a solution to it. I just need to implement it. I was on the phone with the company that runs my site, and it looks like we found a solution. So I should have this all figured out after I close this webinar up, and the recording has to render. So just give it a few minutes and then you should be good. But anyway, I did record, for those of you that missed it, I have a whole presentation I just did on the science of what liquidity is, how it can help you trade, some application demonstrations here. Okay. And then we did some live demonstration as well. So I hope that helps. If not, let's do meet. Let's have a conversation together sometime, just because I do need to make sure everybody gets this. I know it's kind of a tough concept, but it is the most profitable way to trade, in my opinion. And I don't even think it's just an opinion. I think it's truth. You have to trade supply and demand or liquidity to be profitable in this market. Otherwise, have fun with your indicators. Like, I'm literally saying that because it's the only way to make it work. And like I said, I've been trading 10 years, and learning supply demand and liquidity, also known as smart money concepts. It's the only way to make it. It's the only way to make it. Emil says, how far back in time do you go before you start mapping out liquidity? Okay, so the great question. So most of the time I'm trying to find liquidity that's associated, that's been buried and footprinted into the market over the last 2 to 3, maybe 4 days. Okay, so that's why I use my sessions indicator and my kill zone, so that I can, when I'm looking at this, like I'm looking at this right here and I'm saying, okay, is there any other liquidity back here or even over here I should be aware of, right? Now, if you're approaching an all-time high, or like not an all-time high, but like a monthly high, or you're approaching a multi-month high or multi-month low, you're going to have to do your homework and go out to a higher time frame, and you're going to have to go find those things. Like, you're going to literally have to go back to the left side of the chart and find where that is if your approach. So depending on which pair you prefer to trade, if you're going to trade a just one pair, and your pair winds up getting to a multi-month high, then you're going to have to find out like where that is. Okay. I think, Emil, you took a really great trade this morning. You told us about this trade that you captured on the USD CAD. So for example, you caught this move right here to the downside. You captured this liquidity. You would have needed to go back, and you did this, but you had to go back a month to find this liquidity zone right here. So for those watching this in the recording, this is what we talked about this morning. So on the USD CAD, it had a really nice punch to the downside. Yeah, it did help with an indicator, right? But you can find this manually. So here's the structure. Here's the break of the structure. So, and then you just follow it back, right? Follow it back. Here's the structure. Here's the break of the structure, follow it back. Oh, here it is right here. Here's the market's very static in this area. Okay, this is liquidity. Let's include this, right? So basically I'm just including whatever whatever this consolidation is, like whatever's in here that ultimately created this move to the downside. Okay. And that's the thing. A lot of people just use a single candle. Again, if that's what you're going to do, like the people in the candle camp, they're only using that single candle right there. You're going to miss out on a great trade. You really are, if you're just going to go off a candle rather than a zone, right? I don't know anybody that makes a lot of money that just goes off of a single candle method. I'm serious. Like they all claim it's just the candle, just use the candle. Okay, show me your funded accounts if you just use the candle, right? Show me the withdrawals. Like if that's all you use is just a single candle, right? Emil says, what do you mean by multi-month high? So for example, with your USD CAD this morning, you were at a monthly high, which might be a multi-month high right here. So you're approaching it at least. So this morning, where is it? Let's come back. Yeah. So this morning, and last night, this is where the market was last night, right in here. Okay. And you're approaching a multi-month high. You're not too far away from it. It's just up here, right? And it technically hit a month high right over here just yesterday, right? So if you're trading a currency pair that's close to a multi-month high, you're going to have to go even further left in the chart to find liquidity. And you're going to probably have to pull up an indicator like LuxAlgo or SonarLab to find that liquidity as well. Now, if the market were to be just trending, I don't know, like somewhere like in a consolidation, like, I don't know, we'll say like right in here. Okay, there's liquidity below you, there's liquidity above you that was only 3 or 4 days ago, right? Like if I'm trading right in here and I'm looking for liquidity every night, okay, I got liquidity down here and down here, and there's liquidity up here. You only have to go back about 4 days to find it, right? This one right here, you'd have to go back, whatever this thing was right here, you'd have to go back 1, 2, 3, 4, 5, 6, 7 days. You'd have to go back 7 days to find this guy right here, right? So it all depends on where the market is, right? I had to, so Emil, I had to go back on my chart. I had to move my chart back. I had to minimize it like this, and I had to drag it back to go find that on a 15-minute. Ideally, you just go to an hourly or a 4-hour time frame, and you don't have to minimize it like this. So instead of minimizing, I could do like a 1 hour and zoom in, or maybe even, yeah, let's do a 4-hour or a 3-hour. There it is. Okay, so now here's where the candle people are happy. Again, that's what I'm saying. If you're going to just use the candle, it's fine, but it all depends on the time frame you're trading on. See right there, there's your candle. Here's the candle guy. The candle guy would say, okay, there's my last, I guess a green candle before a move to the downside. And again, I don't use that whole candle. That thing is huge. So I would just use, like this, basically this last bear candle inside of the bull candle here. And then that's the impulse, because whatever happened up in there ultimately created this move to the downside that ultimately broke this structure right here, right? So now if you follow this back, there's a really good chance. Yeah, there it is. Yeah, there it is. It tapped right into it, and then it was just boom, just gone, right? So again, if that's my problem with the candle people, is I made this work on a 3-hour chart, but it wouldn't have worked on a 15-minute, and you would have missed the trade entirely on a 15-minute chart, right? So that's why it's a zone. That's why it is a zone. But yeah, that's how you'd go back. So you'd have to just do your homework, Emil, to find where that is. And you just ask yourself this. So, okay, this is where I'm trading. I'm making new highs every single day, basically. So since I'm making new highs, I probably should go back and find out the last time it was in this area. But in fact, you have to. You have to go back and find out what happened. And you map out zones primarily on the 15-minute. Yeah, I typically do 15-minute chart or hourly, but those are my two places I do it. But it looks like you could have done a 4-hour chart to find out. Looks like the 4-hour would have been great, actually. Especially if you're just in the candlestick camp. Like, there you go. The candlestick guys would just do this. They would just take that bull candle before this major move to the downside. And that would have done it right there. So anyway, I didn't capture that trade, but I'm still happy. Like, we made good money last night and we had a lot of other good trades this week. So I cannot complain. I am doing really well right now, and I'm just happy to keep doing well. And I'm looking forward to another great week. But yeah, these are great questions, guys. If you have other questions, let me know in the chat box. Just let me know, or feel free to text or call me or send me a message on Telegram. I kind of prefer the Telegram just because I can screenshot a lot of stuff and send it your way. But however you want to communicate with me is fine. All right, guys, I'm going to go ahead and wrap up. I appreciate your attendance today. Thanks for a great week. I'm looking forward to another one. Have a fantastic weekend, and we'll see you in the next webinar.